then nothing is required. So it really depends on your assessment of probability as you prepare your financials.
Right. So I think the key here is this is something, make sure you understand them if they are in your debt agreements, and then monitor them. Mm-hmm. Okay. So then let's move on to our next topic, which would be debt restructurings. And obviously they can happen for a variety of reasons. And we've talked in previous podcasts about the fact that there's a lot of nuances to think about if you're dealing with a non-troubled debt restructuring. But we skipped right over the topic of troubled debt restructuring. So I thought it'd be helpful for you to talk about that today. So why don't we start things off with the accounting model for a TDR, and then we can talk about how you figure out if you have one.
Yeah, sure. So it's important to think about TDR accounting first when you have a debt restructuring. So by debt restructuring, I mean you have an existing lender and you go to that lender and you make some sort of change to your agreement, and you need to analyze that. So the first thing you need to do is think about if it's a troubled debt restructuring. And we'll get into how to do that in a minute, but just wanted to first kind of frame the impact. So the TDR model can, in some cases, give you a very different answer than a non-troubled debt restructuring. So it's really important to think about that first. So let me just try to explain kind of what the model is. Well, what the model does is it compares the carrying value of the original debt to the future undiscounted cash flows of the new debt. So if those future undiscounted cash flows are more than the carrying value, you're not going to have any gain, and you're going to adjust your interest rate going forward and disclose that you have a troubled debt restructuring. If the future undiscounted cash flows are less than the carrying value, a gain is taken, but you're only writing the carrying value of the debt down to the future undiscounted cash flow amount. So basically the carrying value of the debt, it's set at the amount of all the future undiscounted cash flows, including the interest. And then any payments going forward, you're just reducing that balance. You actually have no interest expense going forward. So what it does, it really holds off a lot of gain that you would get had you not had a troubled debt restructuring. So okay. It really limits the gain.
Yeah, a much different accounting model potentially then. Okay, yep. So obviously very important to understand if you have a troubled debt restructuring. So how do you figure that out?
Yeah, so to have a troubled debt restructuring, you need to have two things. The borrower needs to be experiencing financial difficulty, and the lender has to have granted that borrower a concession. So you need those two things. So figuring out if a company is experiencing financial difficulties is a qualitative analysis, and you're looking at the creditworthiness of the company. Sometimes it can be a little bit judgmental. And then the concession calculation is more just the math, right? So being an accountant, I like to do the math first. Because
yep, me too. It's black and white.
You can figure that out, and if you don't have a concession, you don't have to worry about the kind of more judgmental qualitative analysis. But everybody's different, and some find it easier to do the other analysis first. But I'm going to start with the concession calc. So how you figure out if the lender has granted a concession. Basically, you schedule out all the cash flows of the new debt, so the principal and interest, and any contingent payments, basically any payment that you would possibly have to make under that debt agreement, and you solve for the rate that gets back to the carrying value of the original debt. So it sounds kind of complicated, but it's really not. If you use a spreadsheet, you could just schedule out the cash flows and use some sort of IRR function to get the rate. So you get that rate, and then you compare it to the effective rate of the old debt. And if that calculated rate is lower than the effective rate of the old debt, then you have a concession.
Okay, so this actually is very straightforward. Okay, so Suzanne, I know one question we get in making this calculation is how the fair value factors into it, because in most cases, if the lender is willing to give a concession, then you would at least assume that the fair value is lower than the carrying amount. So do you need to take that into account in making any of these calculations?
No. So actually this test is really just based on contractual cash flows only. So you're right. Usually the lender is going to give a concession if the debt is basically trading pretty low, like the fair value is very low, and it might actually be that the new debt that they're getting in the restructuring has a higher fair value. So kind of economically, they want to do it to kind of increase their value, but it doesn't get factored in here. It's really just looking at the contractual cash flows. And if you cut down your contractual rights under the...
Then it's going to be
a concession.
Okay,
yeah.
That's helpful. You just focus on contractual terms.
Right.
And then going back to the definition of a troubled debt restructuring, you have to have a concession and the borrower has to be in financial difficulty. So now we get to the more subjective part. How do you determine if the company is experiencing financial difficulty?
Right. So next you need to assess financial difficulty. So we're going to look at if a borrower is experiencing financial difficulty. So there's specific guidance that indicates when a borrower is not experiencing financial difficulty. So I would look at that first. So it says if the borrower is currently servicing their debt and they're able to obtain funding from other sources at the same effective interest rate as a non-troubled debtor, and the restructuring is solely only due to decreases in market rates or positive changes in creditworthiness, then the transaction is not a TDR. So that's a gating thing. But that would only happen,
in some cases.
Yeah, like the borrower could probably go somewhere else and get this rate. So the lender just says, okay, let me do it for you because I know you can go do it somewhere else, get the money and pay me off.
Like what happens with people's mortgages.
Yeah,
sometimes.
so they figure they might as well work with them. But if it's not because of only those things, then you should, you need to look further. And the guidance gives you indicators of financial difficulty. It lists out certain factors to consider. So 1, are you currently in default on your debt? Have you declared or in the process of declaring bankruptcy? Is there any sort of significant doubt about going concern? Have you delisted your securities, or is there a pending or threatened delisting? Or forecasted cash flows are insufficient to service the original debt. So that's really a big one. But it's usually the default and forecasted cash flows insufficient to service the original debt that really is probably the reason why the lender is trying to give this company a better deal and kind of work with them because they know they're not able to service the debt. But like I said, these are just indicators. There could be other factors to think about. It's really just somewhat judgmental. And all the factors kind of have to be weighted. It's not like you have to have all of those to have a financial difficulty. You could just have one. It's really, thinking about your creditworthiness as a company and where you were when you issued the debt as compared to now, and has it gone down. And the way I like to look at it, and the reason I like to do the concession first is, if I do the concession calc and there's a concession, to me it seems that there's a presumption that the company must be experiencing financial difficulties. Otherwise, why would a third-party lender come in and give you this deal if you weren't experiencing financial difficulty? Unless, of course, like I said before, there's some sort of, market change or creditworthiness change that's helping you.
Right. So basically, if you don't get through the gate that you're not experiencing financial difficulty and you have a concession, then you have to look hard at whether or not you are having financial difficulty.
Right.
Okay. And then in that case, then you would go down the path of following the accounting for troubled debt restructuring. Otherwise, you should listen to our other podcasts to hear about other restructurings and modifications. Okay, so then Suzanne, let's move on to another topic where I know we get a lot of questions, which is on related party debt restructurings. And this would be focusing on debt that's held by an equity holder of the company. And there can be various reasons that an equity holder might be more willing to restructure debt, which in some cases could include that the company is having financial difficulty. So what should companies think about when they're looking at debt that's restructured with a related party? Again, focus on the borrower.
Yeah, so the key thing to think about is whether or not any extinguishment gain associated with a related party debt restructuring should be treated as a capital transaction. In other words, whether the gain should go through equity as a capital contribution instead of income. And there's no specific guidance on this. There is some guidance that says, a transaction with an extinguishment transaction with a related party may be in essence a capital transaction. So it's kind of vague and it takes some judgment. But generally, if all of the debt holders have equity interests in the company, any gain, it's usually considered a capital transaction. And that's because it's really hard to figure out when someone's a debt holder and an equity holder, and they give the company a good deal, like they let the debt be extinguished at a gain, you have to ask yourself, why are they doing that? I mean,
right, isn't that in essence a contribution?
Helping themselves with the equity contribution. Now, it gets a little more complicated when only some of the debt holders are also equity holders. So you have a mix, like you say, you have a syndicate of debt holders. Some are just regular, let's say, banks or something, and some are equity holders. So you really have to think about those. So to make that determination of, whether the gain should go through income or through equity for those particular equity holders, you should think about the reason that the equity holder agreed to that restructuring. Were they trying to protect their equity investment, or were they really just going along with everybody else, with all the other lenders? And really key is, whether other debt holders that don't own equity, did they get the same deal? So if they get the same deal, it seems like, maybe there really wasn't some sort of special treatment because of the equity interest. And even just think about how large of a percentage of the company does that equity holder own. The more they own, the more
question there is.
Yeah, the more incentivized they are to give the company a better deal, which may indicate capital transaction.
Okay, so Suzanne, these have been great points, and I think probably fair to say as a summary, like many things or all things in accounting, the key here is going to be to understand your transaction, make sure you have all the facts, and clearly to make sure you've read all your agreements. So if someone's been listening to this and now wants to understand more or has more questions, where's the best place to go look?
For the debt restructuring stuff, the troubled debt or any debt restructuring, including the related parties, I would look at Chapter 3 of our financing guide. And then for any debt classification related information, I'd look at Chapter 12 of our financial statement presentation guide.
Okay, so Suzanne, before we wrap things up, I want one fun fact for our audience. Okay. You've been my visitor for debt, cash flow, and leases. So what's your favorite topic?
Yeah, I'm going to have to say debt.
Oh, is that because of today's podcast, or do you have a better reason?
No, it's because I think I've dealt with it the longest, and I enjoy answering questions about debt.
Great. Thanks for joining me today.
Sure.
Don't miss next week's episode when we wrap up all the quarter's issues with the Quarter Close audio edition. In addition, for more quarterly accounting information, I'm hosting our quarterly accounting webcast tomorrow. Please join our live webcast on March 18th, March 24th, or April 2nd, or look for the replay available on cfodirect.com. To make sure you never miss a podcast episode, subscribe to this series wherever you listen to your podcast. And I'd love to hear from you, so write to me at heather.horn@pwc.com, or to stay up to date on the latest content, let's connect on LinkedIn. For PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.
Welcome to PwC's weekly accounting podcast series. I'm Heather Horn. For today's episode, I'm joined by a team of PwC National Office partners to discuss the potential accounting impacts of the coronavirus. In addition to its tragic human toll, we've seen the virus altering business and consumer activity around the world, which in turn may impact your financial statements. With me in the studio, I have Matt Sabatini, Jay Celeber, Ryan Spencer, and Brian Staniszewski to help us understand the potential consequences. Gentlemen, thank you for joining me in the studio today to talk about this important topic. And to start things off, I wanted to focus on the potential impact of the coronavirus on revenue recognition. So maybe Jay, I know there's a few areas, maybe starting with receivables.
Sure, Heather. Starting with receivables, certainly that's probably the thing that comes to mind first
Right.
for companies, right? They've sold goods and services to a customer. They have receivables on the books. Maybe those customers are struggling now. They're running into their own financial difficulties. So certainly you do have to evaluate each period your collectability of those receivables. Basically, it's viewed as running it through the credit loss model, right? It's on the books as a receivable. You have to evaluate the collectability of the receivable as a credit loss.
And Jay, to that point, the FASB's new current expected credit loss model became effective January 1 of this year for a lot of companies. So when they're thinking about the level of uncertainty from these recent events, factoring in their reasonable and supportable forecasts may need to be something that they tweak or adjust based on the level of uncertainty today and make sure that they have controls in place to monitor that uncertainty as it goes forward to ensure that they can adequately document, support, and book their allowance for loan losses, not only on just receivables, but for other financial assets that are within the scope of that model.
So it's an interesting point, Brian. So thinking about CECL, and then for companies that haven't adopted CECL, they're going to need to think about the receivables under the old model. So you really
so you've got the incurred loss model for the pre-adoption of the current expected credit loss model. Then you have the little bit forward-looking model for the companies that have adopted the current expected credit loss.
Right, and it's in the first quarter. It's something companies really are going to have to think about. It's their first time adopting, and they've got world events now that they have
This
to
level of
consider.
uncertainty that they
Right.
haven't dealt with before. So yes, it's definitely a good reminder.
Okay, that's helpful. So then, sorry, Jay, why don't we go back to you?
Sure.
I think that hits receivables, but then moving, how about sales? So now you're talking about revenue recognition.
Right. So the collectability matter, along with sort of affecting the stuff you've already sold,
Yeah.
it affects any new sales in a different way.
Okay.
Right. Listeners might remember that collectability being probable is one of the criteria that the FASB has established for having a contract in the first place.
Right.
So if you have a customer that you're unsure if they'll be able to pay you as you sell new products and services to them, that might mean that you don't have a contract at all, and you may not be able to recognize revenue of any sort. We do have a podcast we had done back in March of 2019 that gets into a little bit more of the details around that and kind of walks through the entire model that you would apply of both upfront and sort of even as you get cash. It might mean as you get cash, you may not even be able to recognize revenue.
Yes, and I will definitely include that podcast in the show notes. And I do remember that was Pat Durbin, and the whole idea that you're getting cash and not recognizing it, I think, was eye-opening for some people. So if you're dealing with these issues, definitely encourage people to look out for that. And then let's say you get over that threshold. I know there's definitely other things you're going to have to think about from revenue recognition. So can you run through that?
Yeah, I would say probably the biggest area is the notion of variable consideration. And variable consideration, sort of as it sounds, is anything where the amount of money that you might eventually receive or keep from a customer could change. And that could include things like rebates, it could include returns of products, it could include liquidated damages for not being able to meet certain timeliness requirements to deliver products. It could be contingent amounts in the contract based on how well or how fast you perform, or even how well a customer performs. Think of perhaps promised gross margins at a distributor, that if the distributor has difficulty selling the product through the channel because of the impact of the virus, that could mean they either return more products to you or maybe you owe them some type of rebate payment to equalize their margin. All of those are forms of variable consideration. And the model says that both when you have an initial sale that has variable consideration in it, as well as every subsequent period after that, you have to keep updating your estimates of how much variable consideration you expect to receive. And the model does have a threshold that says you can only recognize variable consideration if it's probable that a significant reversal will not occur when it's ultimately resolved. And so certainly the impact of the virus is impacting that uncertainty quite a bit. So historical models that companies have used may not be applicable anymore in some
Right.
cases. And it's really a lot to think about because you have to think about your own impact. You have to think about a lot of your downstream impacts at your customers, what might happen there. So certainly no easy answers as to how to do this. But you do have to evaluate it, again, not only just for the ones you're selling this period, but also any previous sales, perhaps, that still have an open element of how much money you'll ultimately receive.
Yeah, it's interesting because I think there could definitely be cases where, let's say at December 31, things were probable because you have your established sales channels, but then now because of events and changes that maybe you didn't anticipate when you recognized initially that it would no longer be probable. And so then in that case, would you be recognizing reversals of what you've previously recognized potentially?
Right, you could. The model definitely contemplates adjustments in either direction for variable consideration. Certainly since it establishes sort of a higher bar, probable bar at the beginning, you don't expect to have lots of reversals, but certainly this is an unusual event, and so we certainly could see reversals of revenue in, let's say, the first quarter, calendar quarter, from revenue that had been recognized in the previous quarter.
And then the amount you're recognizing this quarter also may be different than what you've recognized in the past because of this uncertainty.
Right. You may need to update some of your models and estimates and key assumptions that were in those models as to how much the returns were going to be, how much the rebates were going to be, how fast you would be able to complete a product, things like that.
Okay. And definitely no easy answers given all of the uncertainty that we're experiencing right now, but something companies should be thinking about and monitoring. And then, Jay, as people are looking ahead to Q1, and you have these types of arrangements, where should they look for more guidance on this?
Along with that podcast that we mentioned, certainly our revenue recognition guide walks through certain elements of the model, and there's a variable consideration as well as a collectibility in there.
Okay, good. Very helpful. Thank you. So then, Matt, why don't we move on to impairment? I know that a lot of companies have goodwill and intangibles on their books, property, plant, and equipment, other things that, given some of the changes, depending on where you're doing business, could be impaired. So what should companies be thinking about in this area?
Yeah, it's a good question. I mean, I think companies are already beginning to experience some impact on their current financial performance, but they're certainly thinking about how these global events will impact future estimates and future cash flow projections. So, the first thing to think about is whether or not you have or could have in the near future a triggering event, right? That would cause you to reassess whether or not you're carrying some of these assets at a level that's above where they're valued at. So, these triggering events, there's certainly triggering events listed in the guidance, so you can look at ASC 350 and ASC 360 to kind of read those. But specifically as it relates to what's happening right now, the first thing I think about is the markets, right? So if you think about what's been going on in the stock market, you've had extreme volatility over the last several weeks, and you've had declines in stock prices. That's certainly one common trigger to think about when your market capitalization falls kind of at or below what your carrying value for your assets are. It's certainly a trigger to start thinking about whether or not you have an impairment of goodwill or maybe some other long-lived intangibles. So certainly think about the market. I would think about, maybe some other areas on the revenue side of your business and maybe on the supply side of your business, right? So on the demand side, certain industries I think are going to be more impacted than others. So if you think about customer demand in the travel industry and luxury retail industry, in certain industries that deal with large-scale events like concerts or sporting events, those are things where we're already beginning to see significant amounts of cancellations, although there might be more coming. The biggest thing is the unpredictability, right? So we just don't know what's going to happen over the next few weeks, few months in terms of some of these events. And it has a significant impact on your cash flow projections over the short term and then maybe over the longer term. So certain industries definitely feel it more than others, but certainly everybody wants to think about whether or not they are going to be able to meet demand of their customers. So if they're relying on internal operations or internal manufacturing plants to produce their products in some of the affected areas, that's a concern that might also cause a trigger. On the supply side, it's similar, right? So if you're heavily reliant on receiving raw materials or component products for your goods, and those products are being supplied from other territories, from impacted areas, there certainly could be a delay. There could even be just an inability to procure those goods. So what does that do for your financial projections if you can't source those products elsewhere, or if there's going to be a delay in sourcing or additional costs in sourcing those products? And then on the workforce side, again, if you're reliant on the workforce in some impacted areas, that's a situation where you might want to think about the delays in supply, the delays in being able to produce product that you're intending to sell, or even the impact in the service industry. If you're reliant on physical presence of employees in a certain place, are you even prepared to carry on business in that event? So all of those things, I think, are things that companies should be thinking about in terms of whether they create trigger events, but they also kind of fit neatly into what the next step is, which is you have to revise your financial projections with the current knowledge of of where the market is and weigh in some of this unpredictability. So all of the macro events that we're talking about are going to impact certain companies' financial projections more than others. They're certainly going to impact discount rates when you're thinking about what your projections are, because there's an increased level of uncertainty in the short term and maybe even a little longer out. A couple other areas really just to think about, I'd say companies that have used step 0 for their goodwill impairment test, which is a qualitative approach to testing for impairment. If you have a trigger, certainly step 0 feels like it's going to be less likely to be utilized or applicable for companies. But even if you don't have a trigger and you get to your next annual impairment date, reliance on a qualitative assessment, if you're in an industry that's heavily impacted, again, maybe be less available to you. And then if you're thinking about impairment and where else it may impact, if you have an investment, like an equity method investment or other investment in a company that operates in one of the impacted areas, or that relies, again, on supply or demand from one of these areas, that's something to think about in terms of, do you have an other than temporary decline in value?
So then, Matt, I think that's all helpful and definitely a lot to think about. So kind of the key things there, it seems like then, are don't just wait for your annual impairment, but consider whether you have a trigger, and then that could impact different areas of your balance sheet: goodwill, intangibles, property, plant, and equipment, equity method investments. And then, Brian, you can confirm for me that things that you have carried at fair value, you're just going to have to think about the impact of fair values when you get to the end, to your balance sheet date.
Correct. You have to follow the model that thinks about how a market participant would view in light of all of the relevant facts and circumstances. Correct.
Okay, thank you. So then why don't we move on to you, Brian, so good segue, to some of the other areas in terms of hedging or potentially debt modifications. What are some of the types of things companies should be thinking about?
Yeah, so I'll start with hedging, and more specifically cash flow hedge accounting. So one of the gating criteria in order to apply a cash flow hedging model is that the forecasted transaction is considered probable of occurring. So as the level of uncertainty increases due to some of these recent events, that may put pressure on the probability assertions that companies have made when asserting that their future forecasted transaction is considered probable of occurring. Some of the examples of this uncertainty may be driven by, idle or closed plants, supply chain disruptions, or just the general decline in the economy. So when you're thinking about cash flow hedge accounting and you've gotten to a point where you've realized that the level of uncertainty has caused the forecasted transaction to cease to be probable of occurring, at that point in time, prospectively, all changes in the derivative's fair value shall be recognized in earnings. Then the question comes into mind around, well, what happens with the amounts that were previously deferred and accumulated other comprehensive income? Which is, I think, a really good question, and that's where a lot of the judgment comes into play. So that amount is required to be released into earnings when either the hedged forecasted transaction affects earnings, or it's determined that the forecasted transaction is probable of not occurring. So in thinking about this level of uncertainty and whether or not the hedge transaction is probable of not occurring, if that is in fact the case, then the guidance would require you to immediately take the amount of derivative gains and losses that were deferred in AOCI and recognize that in earnings immediately, which in the cash flow hedging model would be considered a missed forecast.
So Brian, just one key thing there, though. You could be in a situation where you have to stop accumulating future amounts. So you stop hedge accounting, but that doesn't mean you've triggered the release of the previously deferred amounts from AOCI.
Correct. Yeah, this is where there's always been a lot of judgment applied. And when you're thinking about what you're hedging to occur in the future, you have to look at it from the perspective of it's probable based on the accumulated evidence that you have in the history of these type of transactions. And when you determine it ceases to be probable, then you have to stop hedge accounting going forward.
Yeah, so there's a gap in between there.
So it's either probable of occurring, it ceases to be probable, and then when you get to probable of not occurring, that's when you have to release amounts that were accumulated in other comprehensive income into earnings. But if it's determined that it's not probable of occurring,
right,
then you would still retain the amounts in AOCI and release those when the actual hedged item forecasted transaction affects earnings.
Okay, so definitely something to focus on. And then how about from a debt modification perspective?
With debt modifications, with some of these events and the uncertainty that companies are facing, they may face constraints on cash resources, which in turn may result or require them to have to go to their existing lenders and modify the terms of their existing debt agreements. And I guess just one reminder when that is taking place is that there's different models that you have to think about in the debt modification guidance. You have to, one, consider whether or not the modification is considered a troubled debt restructuring, and then also think about whether the modification results in a debt extinguishment. And if not, either of those two, then you'd have to apply the debt modification model, which has its own kind of separate bells and whistles. So there's 3 different models you have to think about when you're modifying the contractual terms of the arrangement that companies will need to consider if that in turn ends up being what they have to do.
Okay, that's helpful. And actually, I'm having Suzanne Stefani in the studio next week to talk about all of those different models. So just a little more background on that specific topic. So that's great. Thank you, Brian. So then why don't we move on to our next topic, which would be other areas which maybe aren't quite as pervasive, but I know from talking to you all in preparation, there's a lot of other things that could be impacted. And so at least want to give people some things to think about. So I'll throw it out to the group. What other topics do we have that we want to highlight?
I think we could start with restructuring. Anytime you have a significant disruption to operations, companies are going to start thinking about, is there potential, does it warrant a kind of restructuring of certain aspects of my business, including maybe the geographic concentration of suppliers or personnel or inventory. So just a couple heads up to keep in mind when you're thinking about restructuring operations. You only record a restructuring liability when an event has occurred that creates a present obligation. So we just want to make sure that folks are cautious about recording a liability too far in advance of when they've actually incurred that obligation to spend that money. So you might have a commitment to a plan of restructuring. That's not generally enough to warrant the recording of a liability because it doesn't create an obligation in the present sense. You could have relocation costs, inventory kind of moving costs for personnel as well. Those are generally expensed as incurred, so that's not going to be something that you're going to estimate over the next few months and record a liability for. I think people are thinking about maybe employee severance costs as well. I know, Jay, that could be complex.
It can kind of depend a lot on sort of the types of plans a company has or doesn't have, and to your point of when can a commitment to a plan create a liability. In some cases, if a company has an existing severance plan, it may be enough that once the company has a plan and they can determine it's probable and estimable that you could accrue those severance costs. But if the company doesn't have a plan in the past and it's sort of a one-time arrangement, there's different guidance for that, and that would say that you have to both have a plan, you have to communicate what the benefits are, and in most cases you'll probably be recognizing those costs just prospectively as opposed to all immediately.
Yeah, so that's for employee relationships and contracts. I think if you have vendor contracts, that might be also something that you're thinking about terminating or modifying. So generally, if there's a termination provision within the contract, given notice for termination, you could record that termination penalty as a liability. But otherwise, if it's going to be a negotiation, then you generally wait until that negotiation is complete before recording any liability related to a termination.
Okay, so then companies that are thinking about restructuring or starting to look at this area, then it's really going to depend where they are in sort of the process, what will be recognized as of the end of this quarter versus maybe things that will be recognized in future quarters.
That's right.
Okay, that's helpful.
So one other area that we've started to see is certainly we've seen companies talk about updated projections and financial forecasts, and maybe things aren't going to play out as well this year as they had originally planned. And in that case, that may affect sort of their either bonus plans or their stock compensation plans in the sense of how much might people earn under the plan. Certainly, if forecasts have come down and now they're going to pay out less, you'd want to lower the amount you've accrued for that. But particularly as it relates to stock comp, we've seen some companies at times thinking about, well, maybe I want to adjust my targets or I want to back out some of these one-time effects and not count them against the targets. But that's not necessarily part of the original terms of the plan. So if a company starts changing the terms of the plan by backing the items out or changing what the targets are, that's viewed as a modification of the stock compensation arrangement. And that's a complex area, which in many cases can either result in a new measurement date if the award was now viewed as not being probable of being hit prior to this change, and now you change it so that you can hit it. That might be a whole new measurement date of the plan. Or even if it was probable, but you're changing maybe the amount that you think people will receive, that could result in recording some additional cost for giving people more than they had before.
That's a great point, Jay. I think one other area that might be good for companies to think about is business interruption insurance. And I think overall, before you get into the accounting, it's important to make sure you read the policy and figure out whether or not some of these recent events due to the coronavirus might actually affect your business in a way that your policy covers. So Once you've kind of crossed that bridge, which I think is the big area of complexity that you need to weave through, from an accounting perspective, the insurance recovery kind of model would basically have you look at the contingent gain model. So when you have insurance recovery and you don't have an actual loss accrued on your balance sheet because of the events that have taken place, they just are a loss of revenue. The ability to recognize the gain or the asset for the potential recovery from the insurance company is a pretty high bar. So it's basically, once you've identified that your policy covers the losses and you've had negotiations and kind of confirmation with the insurance company that they're going to pay, to a point where it's realized or realizable, that's when you would recognize the gain contingency. But until you've reached that high threshold, then you probably wouldn't have anything to recognize.
Okay, so again, this is something to focus on this quarter, but potentially not something that will be recognized depending on, again, where you are in the cycle of evaluating. Okay, that's helpful. Any other areas?
I would say one last area is in the area of inventory. And I think both Matt and Brian have touched a little bit upon capacity considerations. And there's an interesting quirk in the inventory accounting model that says, normally, of course, you have overhead costs, you're absorbing those overhead costs into the inventory you're producing. The guidance contemplates that all production facilities have a range of normal capacity utilization. There's lows and there's highs, there's ebbs and flows during the year. But if you have a period of abnormally low production levels outside of that normal range, then you should record some of those costs directly to cost of goods sold. You don't end up capitalizing them into inventory because it's viewed as overcapitalization effectively into the inventory. Now, the tough part is there's no clear guidance or explicit guidance as to what's normal and what's abnormal. It's going to be a very fact and circumstances judgment based on kind of a company's historical operating results and historical ranges. And then sort of lastly, of course, certainly not lost on anyone, that there could be lots of inventory reserve issues for writing down inventory that can't be sold. Certainly a lot of high-end retail stores have been closed and for an extended period of time in many affected areas. And so there's a lot of inventory reserve issues to think about. And don't forget to think about firm purchase commitments for any more inventory that still has to come when you're evaluating what your losses are for the inventory you have on hand.
Okay, those are all helpful topics. So then why don't we just wrap things up today by turning to disclosure. And Ryan, you've been waiting patiently, so thank you. And talk about a couple areas, both considering from a U.S. GAAP perspective, and then I know there's a lot of considerations from an SEC perspective.
Yeah, Heather, I know that many companies are thinking about disclosures, and I'll talk about disclosures at two levels. We'll talk about U.S. GAAP requirements that would apply to all companies applying U.S. GAAP, and then we'll spend some time on SEC filings. So as it relates to U.S. GAAP requirements, there's two areas I wanted to highlight: subsequent events and risks and uncertainties. So as it relates to subsequent events, we are seeing companies carefully evaluating whether there have been any events that would require disclosure in the financials if those financial statements have not yet been issued. An example might be the closure of a facility, change in business practices, change in debt arrangements, covenant matters, et cetera. The subsequent event guidance also contemplates that in certain circumstances, there could be events that might require an adjustment to the numbers as well. The second area of GAAP that's relevant here is disclosure of risks and uncertainties. So ASC 275 requires financial statement discussion of estimates when it is at least reasonably possible that the estimate will change in the near term and the effect of the change would be material. So Heather, this guidance gives examples of some of those estimates which may be particularly sensitive, and many of them are items that we've discussed on this podcast today. But just a reminder for companies that if disclosure is required under the standard, then the guidance requires companies to specifically indicate the nature of the uncertainty and not just simply state that the estimate could change without explaining why.
Okay, that's helpful. But then, so that's sort of across the board. And then how about specific considerations for public companies?
Yeah, so for public companies, we know they're also thinking about disclosures outside of the financial statements in their filings. So this would be areas such as the business section of the document, risk factors, or MD&A. And when evaluating what to say in MD&A, if anything, just a reminder that the threshold in the regulations are those trends that have had or that the company reasonably expects will have a material impact on results of operations. So this could include any impact on demand or potentially any second order effects such as things happening down in the supply chain.
I was just thinking that all these areas we've talked about are ripe for making sure they get into these various disclosures.
Yeah,
on
absolutely.
The podcast today.
So to our listeners, this podcast was originally recorded on March 6th and released on March 10th. Since that time, there have been a number of SEC developments, and we know the podcast is still getting a lot of listeners as an overview of COVID-19 issues. So in a first for us, to make sure we're bringing you the latest information, on March 30th, Ryan and I spoke remotely from our homes to update the SEC discussion. And we focused on two topics. First, the relief being offered to those companies affected by COVID-19. And then second, we talked about some disclosure guidance that the SEC staff issued. So Ryan, can you get started?
Yeah, sure. So as it relates to the deadline relief, Heather, if you recall on March 4th, the SEC had granted deadline relief to companies with filings due on or before April 30th. So for calendar year-end companies, this did not include their Q1 2020 10Qs because those are due after April 30th. So on March 25th, the SEC issued an order extending that relief to cover filings which would otherwise be due between March 1st and July 1st, 2020, giving them an additional 45 days.
And then Ryan, what types of filings does it cover?
Yeah, so there's a number of filings that are subject to the order, and this list includes, but is not limited to, 10Ks, 10Qs, and 20Fs for the foreign private issuers out there. So it does cover the big ones. It's important to highlight that the relief is available only if the filing cannot be made due to circumstances related to COVID-19. And one of the requirements of the order is that companies taking advantage of it will need to furnish an 8K by the original filing deadline. And in that 8K, companies would need to state that they're taking advantage of the order, would need to explain a few details regarding the situation, and a risk factor disclosure if material. The second item that I wanted to talk about is that on March 25th, the same day that that order was issued, the staff of the Division of Corporation Finance of the SEC issued disclosure guidance related to COVID-19. It's titled CF Disclosure Guidance Topic Number 9 and is available on the SEC's website. While this guidance isn't really a rule, so to speak, that needs to be complied with, it provides a helpful outline really for companies to review when evaluating their disclosures related to COVID-19. And I think it's good because it also gives you a sense of the lens that the staff would be looking through when evaluating whether the disclosures are compliant with the rules and regulations. So overall, I'd encourage preparers to take a read of it. It's a couple pages long, but there's a couple of points in it that I wanted to highlight. One is just as it pertains in general to disclosures, the disclosure guidance actually lists about 10 bullets where there are questions that the staff is asking companies to consider or ask themselves when they're evaluating the disclosure. So many of it are topics that we've discussed on this podcast previously, but will there be changes in judgments about fair value measurements, potential for material impairments? How has COVID-19 and the changing economic outlook impacted your financial position, your results of operations? How do you expect it to impact it in the future? And will the future potentially be different than the current period? There's another question asking companies to consider how their staffing arrangements or their remote work arrangements may adversely affect financial reporting systems, internal controls, or disclosure controls and procedures. So overall, this guidance encourages companies to consider all the impacts and to provide tailored disclosures and avoid selective disclosures.
Yeah, I think definitely very helpful, Ryan. And I know you mentioned it's on the SEC website, but we'll also include a link to this guidance in the show notes to help our listeners find it. One other thing, Ryan, the guidance also addressed earning releases, correct? So what were some of the things they talked about there?
Yeah, sure, Heather. So in this guidance, the SEC staff also acknowledged that many companies release earnings estimates and other financial results well in advance of finalizing the required financial reporting for the period. And in this case with Q1, it could actually even be an extended period potentially. So one of the things that the staff discussed in the guidance was non-GAAP measures, recognizing that companies have existing non-GAAP measures or may be inclined to have a non-GAAP measure that adjusts for the impacts of COVID-19 or adjusts to exclude the impacts of COVID-19. And in doing that, they remind companies of the regulations and rules around non-GAAP measures, one of which is the requirement that if a non-GAAP measure is presented in an earnings release, that it is reconciled to the most comparable GAAP measure. And in this release, the staff indicated and recognized that there may be situations where that non-GAAP number is ready to go, but the associated GAAP number still requires some work. So, for example, an impairment charge that would be reflected in net loss and potentially not reflected in EBITDA. And so in this guidance, what they indicated is that the staff would not object to having preliminary GAAP results be the number that's reconciled to as opposed to the finalized GAAP number. And those preliminary GAAP results would have to either include provisional amounts that are based on a reasonable estimate or a range of reasonably estimable GAAP results, and indicated that if the company is going to do that, then the non-GAAP measures that it should do this for should be limited to those non-GAAP measures that are actually used internally, that are reported to the board of directors. So if there are going to be provisional amounts, they did want to make sure it was constrained to just that population of non-GAAP measures. They also indicated in the guidance that it would not be appropriate to have provisional GAAP amounts, obviously, in a 10K or 10Q that has the final GAAP issued financial statements for the period.
Right. Yeah. So Ryan, definitely helpful guidance. And to your point, I think important for companies to get familiar with this if they do plan to make these types of disclosures. Maybe why don't we turn our attention then to an area where I know we're getting a lot of questions, which would be what we're seeing so far in terms of SEC filings and disclosures related to COVID-19.
Yeah, well, Heather, we saw, as it relates to the S&P 500 annual reports during the season, we saw just over 40% of them filed in February or early March reference COVID-19 in some way. But as you might expect, since then, there's been quite an uptick in the amount of disclosures in quarterly and annual reports, as well as in a heightened number of 8Ks that are either updating earnings guidance, pulling guidance, or updating other disclosures such as risk factors. And we've seen this trend increasing though, and with the Q1 reporting cycle upcoming, we'll undoubtedly see a substantial majority of companies disclosing something related to it, I would expect. And also, as companies are considering the impact of COVID-19 on their disclosures, I also wouldn't be surprised if we saw additional disclosures for foreshadowing of potential impairments and goodwill impairments, say, for at-risk reporting units.
Yeah, I think that's a reminder we often give that if you think there's a potential impairment in the future, better to disclose what you know now and share that information with your financial statement users. So Ryan, thanks so much for this update. I think very helpful for our listeners to bring them the latest. Any final thoughts to wrap things up?
Yeah, I would just say that the SEC did emphasize in this guidance, though, that the public health and safety is the first priority, and that this should not be compromised in any way to meet financial reporting requirements. And with that, they mentioned and encouraged companies to reach out to them with any questions about reporting, deadline relief, and disclosures.
Great. Thanks again.
You're welcome.
All right, well, so gentlemen, thank you so much for joining me today on this important topic. I know it's on a lot of people's minds, and I think this podcast can be a helpful resource together with our In the Loop that we've issued. And then we will also be providing additional discussion in our upcoming webcasts to be held later in the month. And to wrap things up, let's end with a safety moment and a quick